Have you ever seen something in the market that just doesn't make any sense? Well, today we're going to dive into the wild story of SBC Medical. It's a perfect case study of how sometimes the story a company tells can completely overpower the actual numbers on the page. So that brings us to the big question, the central mystery of this whole thing. How on earth does a company's stock price go up after what looks like a total disaster of an earnings report? It sounds like it should be impossible, right? But believe me, it happened. Okay, so let's set the scene. It's the morning of August 13th, 2025. SBC Medical is dropping its latest quarterly results. And just looking at the headlines, investors had every single reason to hit that sell button fast. First up, the all-important earnings per share, or EPS. The company reported just 2 cents. Now, a number like that doesn't mean much in a vacuum. The real kicker is, what was everyone expecting? Well, the analysts, the folks whose job it is to follow this company, they were all looking for 14 cents a share. Yeah, you heard that right. That's not a small miss. That is a massive 85% miss. In the world of quarterly earnings, a miss that big is usually a catastrophe. And it actually gets worse. Let's look at revenue. The company brought in about $43.4 million. And again, just like with earnings, this was another big disappointment compared to what the market was hoping for. And this wasn't just a miss against estimates, it was an 18% drop from the same time last year. So let's be crystal clear. We've got a gigantic earnings miss and revenue that's actually shrinking. By any normal metric, this was a truly awful quarter. So why didn't the stock just completely collapse? Well, because this is the exact moment where the numbers stopped mattering and the story took over. Management didn't try to sugarcoat the bad news. No, they leaned into it and said this was all part of the plan. The CEO, Mr. Iacawa, came out and said this was all about laying the groundwork for the future. He wasn't apologizing for a bad quarter. He was reframing it. He was basically telling investors, we had to take a step back to take a giant leap forward. And they had their reasons ready. They talked about restructuring, new fee models, and even some one-time tax stuff. But the crucial part of their message was this. These are not signs of a broken business. These are temporary one-off issues that are already in the past. And you know what? It worked. The market almost immediately stopped looking at that messy Q2 and started focusing on what the company was building. And this is where the story gets really, really good. You see, if you just zoom out a little, right before this earnings report, SBC was on a roll. They were making some really smart moves, getting added to a major stock index, bringing on a heavy hitter as an advisor, and this is the big one, acquiring a super promising new business called JUN CLINIC. And that acquisition gets right to the heart of their new playbook. SBC was shifting its entire focus. They were moving away from general services and going all in on specialized high-end clinics. These new brands, like JUN and NeoSkin, were designed to attract customers who spend a lot more, which of course means much higher profitability. And it wasn't just the business model. They were strengthening the whole company from the ground up. We're talking top-tier hires, buying back their own stock, and making the company more attractive to those big institutional investors. They were sending a crystal clear signal. We're building a serious, stable growth machine here. All right, so you've got the terrible numbers on one hand and this really compelling story about the future on the other. So what did the market actually do on that crazy day? This is honestly just incredible. Before the stock market officially opened, when all anyone could see was the bad news, the stock was tanking, down 7.5%. But as soon as the earnings call started and management began telling their story, investors started buying. The stock did a complete 180, finishing the day up over 5%. Just a stunning turnaround. So what do you even call this? Well, analysts have a term for it. Cautious to constructive sentiment. It's really just a fancy way of saying the market was willing to look past one really ugly quarter because it was so optimistic about the long-term vision. When it came right down to it, investors made a choice, and they bet on the story of a strategic turnaround and a brighter future instead of getting spooked by some bad numbers that were already in the rearview mirror. But, and this is a big but, the story is not over, not by a long shot. Management successfully bought themselves some time and a whole lot of goodwill. They promised a big turnaround, and now the pressure is on to actually deliver the goods. And we know exactly when that first big test is coming. Go ahead and circle November 12th on your calendar. That's the day SBC releases its next report. It'll be the first real piece of evidence we get to see if all this groundwork is actually paying off. Which leaves us with the ultimate question, right? Did the leadership at SBC pull off a brilliant strategic pivot navigating a really tough transition? Or was this just a massive gamble where a great story was just used to kick the can down the road? We'll start to find out on November 12th.